You really can't escape it. Turn on the news and it feels like every single headline is about this epic battle between two giants, inflation and economic growth. We're always told we have to fight one to get the other. But what if that's not really the whole story? What if the relationship is a lot more mysterious? And what if a little bit of inflation is actually what an economy needs? So we're going to dive deep into this one central question. For decades, you've had economists wrestling with it, and trust me, the answer has changed a lot. It's a really cool story about a beautiful theory, a very harsh reality, and a surprising new discovery. All right, so our story kicks off back in a time when economists kind of thought they had it all figured out. They really believed they'd stumbled upon a fundamental law of the economy, something as simple and predictable as, well, ordering from a menu.
So back in 1958, this economist, A.W. Phillips, is digging through almost 100 years of British data, and he finds something incredible, a super clean inverse relationship. When unemployment was low, wage inflation was high, and when unemployment went up, wage inflation went down. It was so consistent, it looked like a law of physics for the economy.
You can just imagine the excitement, right? For governments and central banks, this wasn't just some boring academic paper. No, this was a practical tool. It meant you could actually choose your economic outcome. You could pull the levers. And this idea was so powerful that a couple of other famous economists, Solow and Samuelson, applied it to the US, and they literally called it the menu of choice. A policymaker could look at this curve and say, okay, we'll take a little more inflation, say 5%, to get our unemployment rate down to 3%. It was presented as this simple, elegant trade-off. But you know how these stories go. Just as this idea was basically becoming economic gospel, a massive plot twist shows up. And it comes from one of the most influential economists of the 20th century, Milton Friedman. He stepped in and said, hold on, everybody's missing a huge piece of the puzzle here. Friedman's argument was just so powerful. He basically said, look, sure, this trade-off might work in the short term, maybe as a surprise, but he argued you can't fool people forever. The moment people start to expect higher inflation, well, the whole game changes. And it all boils down to this concept of inflation expectations. Just think about it for a second. If you and I and everybody else expects prices to jump by 5% next year, what are we going to do? We're going to go to our bosses and demand a 5% raise just to stay even, right? And businesses, knowing this, will go ahead and raise their prices by 5%. And poof, suddenly you get that 5% inflation, but it doesn't buy you any lower unemployment. The trade-off just vanishes. Now, back in 1968, Friedman's idea was just a theory, but then came the 1970s, and the real world provided a brutal, just undeniable confirmation that he was right. The 1970s were frankly an economic nightmare. That simple menu of choice was completely thrown out the window. All of a sudden, you had both inflation and unemployment soaring at the same time. This wasn't supposed to be possible. They actually had to invent a new word for it, stagflation. And it was exactly what Friedman had warned about. And this contrast just says it all. On the left, you see the elegant theory, that clean, predictable curve. On the right, that's the messy reality of the last 50 years. It is not a curve. It's a chaotic cloud, a scatterplot. The simple trade-off was officially dead. So, the total failure of that old model forced economists to start asking a brand new and honestly a much better question. The focus shifted away from that simple trade-off and toward a much deeper, more important relationship. This really forced a fundamental change in thinking. Economists stopped asking, how much inflation should we accept for a little less unemployment? Instead, they started asking a much bigger question. At what point does inflation start to actively damage the entire engine of the economy, our overall economic growth? And that brings us to the modern view. See, it's not about a smooth curve anymore. It's more like a threshold or a tipping point. The idea is, below a certain level, inflation might not be a big deal for growth. But once you cross that line, it starts to become a real poison for the economy. So, the obvious question is, what is that tipping point? Well, a huge recent study covering 108 countries from 1970 all the way to 2023 tried to find that exact number. And the results are absolutely fascinating. Okay, so for developed economies, we're talking the US, Germany, Japan, places like that. The study found that the damage to economic growth really starts to kick in once inflation gets past about 6.7%. Below that level, the negative effects just aren't statistically clear. Now here's where it gets really interesting. For developing countries, you might think, okay, totally different economies, the number must be way different.
But amazingly, the tipping point is almost identical, around 6.1%. That's the level where inflation starts becoming a drag on their growth too.
But here is the most surprising finding of all. That tiny little gap between 6.7% and 6.1%, while statistically speaking, it's meaningless. The data shows that despite all the vast differences in their economies and institutions, the inflation danger zone is effectively the same for everyone.
And once you do cross that threshold, the damage is very real. For every 1% that inflation climbs above that 6 to 7% zone, it shaves about 0.07% off of GDP growth in developed countries. And in developing countries, the effect is a bit stronger. It cuts their growth by about 0.12%.
Okay, so, wow. We've gone on quite a journey, right? From a simple menu to a completely broken model, all the way to this modern theory of a tipping point. So, what are the crucial things we should take away from all this?
Well, there are 4 really crucial points. First, that simple Phillips curve trade-off, it's a myth. It's long gone. Second, what we all think inflation is going to be tomorrow is an incredibly powerful force that shapes the economy today. Third, and this is the big news from recent research, there really seems to be a universal inflation danger zone right around 6 to 7%. And finally, once you're in that zone, higher inflation clearly, unambiguously means lower economic growth.
And this leaves us with the absolutely agonizing dilemma that every central banker is facing right now. They know that letting inflation run hot, above that 7% threshold, will damage the economy. But the main tool they have to fight it, hiking interest rates, is also designed to slow the economy down, which hurts growth, at least in the short term. So how do you choose? Which path do you take? That is the tightrope they are walking every single day. And it's that balancing act that's going to shape all of our economic futures.